Hey everyone, it's Iggy from the Investing Iguana, your go-to guide for cutting through all the noise in Singapore's fast-moving investment scene. Today, we've got one of those million-dollar questions investors always ask. Is Soon Hock Enterprises IPO the ticket to riding Singapore's next big industrial property wave, or just another blip on the SGX radar? Let's jump straight in. If you're a regular here, you know the Investing Iguana ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the mind-blowing 1 million reads with over 58,000 likes. That's thanks to you and this awesome investing community. Plus, we've churned out more than 1,000 videos, racking up more than 600,000 watch hours as of August 2025. I keep an eagle eye on Singapore, but my analysis stretches across the region too. So, rest assured, you're in good hands. This script is adapted from my latest deep dive on Substack, where we break down Soon Hock Enterprises' $48 million IPO and look beyond the headlines, straight into the engine room of Singapore's industrial market. Stick around as we uncover why Soon Hock's business model is both its lifeline and its biggest risk, the real story behind Singapore's mega infrastructure play, the cold truths of industrial property cycles, and how to spot them, plus Iggy's honest verdict and lessons for Singaporean investors. And yes, there'll be lively tables, punchy visuals, and a playbook for putting it all together. Imagine this. You're an investor eyeing the Singapore exchange, searching for your next big move. Soon, Hock Enterprise flashes up. 58 cents a share, strong pre-sales, and a lineup of big cornerstone investors like Maybank Asset Management and UOB Kay Hian. You ask yourself, will this relatively small player really cash in on Singapore's mega infrastructure build-out, or am I stepping into a classic property developer roller coaster? If you've been confused sussing out IPO risks, you're not alone. Property developers, especially in the industrial space, love to trumpet the next Tuas Mega Port or the latest logistics park, but behind the buzz lie big swings in revenue, timing, and dividend reliability. So today we go deep, no surface-level IPO hype, just the facts, analysis, and the lessons for investors like you. Soon, Hock has built its name around Singapore's industrial property sector, launching over 200 strata-titled units and wearing two hats, project developer and investment property landlord. In English, they roll out new properties for sale and collect recurring rent on assets they hold. Revenue swings are wild. In FY 2023, Soon Hock bagged $264.7 million. Fast forward to FY 2024, just $7.9 million. Why? Project completion cycles. If no temporary occupation permit lands that year, revenue tanks. The stable part? A small rental income stream from properties in Keki Bukit and Jalan Papan, plus a workers' dormitory filled to max. Visualize a table showing revenue dropping from sky-high FY 2023 levels to next to nothing in FY 2024. Rental income makes up just the sliver, enough to keep the lights on, but not enough to excite investors. The main lesson: you need to understand when a developer actually recognizes earnings, not just what's in the pipeline. So what about their current projects? Picture Stellar at Tampines, an industrial development with 311 units, 168 of which are already snapped up before completion. That's more than half sold, showing strong demand and shrewd location choice. Then there's Sky at Tuas, a gamble on the West Singapore corridor with features tailored for logistics giants who want to piggyback the Tuas Mega Port development. Soon Hock is plowing its IPO money into snapping up more land, funding a redevelopment at Shaw Road, and keeping the current pipeline healthy. They're guessing the big Singapore industrial land play has legs. The policies and land tender process support scale players, but smaller developers like Soon Hock need sharp execution and airtight capital management. Recap: the pipeline looks hot, but as always, revenue only counts when projects wrap up and buyers move in. Ask yourself, are you patient enough to weather development lulls for the eventual payday? Let's zoom out. Why is industrial property such a big deal here? The $20 billion Tuas Mega Port will be the world's largest automated terminal by 2040. Its scale is monstrous, the kind of infrastructure project that turbocharges demand for logistics, warehousing, and even worker dormitories. Industrial rents have climbed for 19 straight quarters up to Q2 2025. JTC's index highlights 0.7% quarterly growth, with some segments, like business parks and multi-user factories, seeing premium demand and extremely high occupancy rates. Imagine a punchy table where you see rent growth dissected by segment: business parks, warehouses, multi-user and single-user factories. Occupancy rates hover near 90%. Supply remains tight, which is a big win for developers who time their launches well. If you want to see every revenue chart, rent growth table, and project timeline, hit up the full Substack playbook. Link in the description. Let's get real. Industrial development isn't for the faint-hearted. Profitability ratios in industrial property hover around 80%. Residential, often 97 to 100%. That means more risk, fewer slam dunks. Macroeconomic headwinds still matter. Slower global trade or tariffs. Singapore's manufacturing and logistics activity contracts, and property demand could follow. Developers face financing challenges. Interest rates, currency volatility, they all eat into margins. Large REITs might weather these storms with diversified assets. Smaller players, not so easy. Imagine a table, risk categories lined up: revenue volatility, macro cycles, competition, financing costs. Soon, Hock's smaller size means they're always at risk of being squeezed by big players or adverse conditions. If you're investing, know your limited downside protection. With all these risks, does Soon Hock justify a premium valuation at IPO, or do you wait and watch for this cycle to turn? Here's the plain truth. Soon Hock offers authentic exposure to Singapore's industrial property boom, but also comes with all the baggage of a lumpy project developer. The IPO pricing is fair but not screaming buy, especially if you're risk-averse. Stellar at Tampines sales and the strategic sky at Tuas move earned them a gold star, but the extreme swings in earnings make them a sideline candidate in diversified portfolios. Bigger, steadier industrial REITs might be better suited for long-term investors needing clear cash flow. For those who love the development game and can stomach the unpredictability, Soon Hock's IPO could be your bet. Just manage your allocations smartly and be ready to sit through market cycles. Singapore's challenge is clear: balancing the excitement of new mega projects against old-fashioned developer risk. The best investors know how to read cycles, assess new offerings critically, and never chase hype unprepared. In summary, Soon Hock's IPO shines a spotlight on what's special and risky about Singapore's industrial boom, but also serves as a classic case of property timing over property type. If you're bullish on mega infrastructure and can ride the waves, fine, but if you want steady cash flow, look elsewhere. If you found these insights handy, smash that like button, subscribe, and share with your circle. This keeps us building the smartest regional investing channel out there. For full written analysis, charts, and my Singapore property investing playbook, grab the latest on Substack. Link in the description. Next up, catch my video on top Singapore industrial REITs. Risk versus reward in 2025. Let's keep making every investment decision smarter. Together.